Good morning and welcome to our Asian Bond session of our Regional Investment Conference. I'm your moderator, Jason Pang. Our guest speaker today is Murray Collis. He's based in Singapore. He's our firm's Deputy CIO for Asia ex-Japan Fixed Income. Good morning, Murray. For the next 20 minutes, we'll be helping our audience connecting the dots between Asian bonds, sustainable income, as well as sustainable investing. I'd like to remind our audience, throughout the session, please send us your questions you have in mind. We'll be taking them in the final part of the session. We'll also have live poll questions, and this will require your participation. The first topic I'd like to discuss about is negative yielding bonds. Some of you may have participated in the session yesterday. Francis Donald mentioned around 25% of the Bloomberg Barclays Global Aggregate Bond Index is in negative yielding territory. To put this into perspective, this equates to around 17 trillion of assets in negative yielding bonds. For investors who follow closely the Fed's dot plot, it also projects that rates are likely to stay low through 2023. So to our audience first, how would you make sense of this? So I'd like to load up our first poll questions. So that will be probably coming into your screen now. For the first poll question, do you see negative yield bonds in developed bond markets as an opportunity or risk for the investment landscape in 2021? So you've got a choice of two, as A, opportunity, or B, risk. Where the results are still coming in, so let's give it another 20 seconds. We're seeing a bit more onto the opportunity set, around 70 towards the opportunity and 30 towards the risk. It's still somewhat changing as we're getting more data coming in. Okay, I think the results are set. So Murray, the poll suggests us that 74% or 75% is seeing as an opportunity, whilst a quarter, 25% is seeing as a risk. So Murray, from your perspective, what does negative yield bonds in developed bond markets mean for investors, and how does Asian bonds fit into this big picture?
Thank you, Jason, and good morning to everyone, and thank you for joining today. And I think the poll results are certainly interesting and heartening to see that investors are thinking of the opportunities that lie out there for 2021, and certainly. We think that negative yields in themselves on the global basis really point to the opportunity that we see within Asia. As Jason just mentioned, there's about $17 trillion worth of negative yields globally at the moment, and that's quite a significant rise, up almost 50% since the start of the year. If we think back to the start of 2021, the US Treasury yield was just below 2%. And as COVID started to emerge during late February and into March, we saw quite an aggressive rally in interest rates, not just in the US of about 100 basis points, but we also saw a broader rally across most markets globally, and particularly we saw rates rally in developed markets to yield lows. As we saw those yields rally, it was really a reflection of central banks globally cutting interest rates and really expanding their balance sheets to help try and support the global economies. And what we saw was governments also undertaking fiscal expansions really to try to support their economies. And I think that's a good opportunity really to bring up the first chart, which should show us really the state of play for yields globally at the moment. And so what we have here is the major global bond markets and their yield curves. So going across the top from left to right, we can see 1 years out to 30 years in terms of the yield curves, and down the left-hand side on the axis are the global economies, and we can see there that most of the developed markets in Germany, France, some of the majors like the United Kingdom are experiencing negative yields, and many are experiencing negative yields across their curve. Contrasting to that, we can see in the bottom part of the chart, really showing up very clearly in green, are the local sovereign bond markets here in Asia. So, this is the likes of Singapore, Thailand, South Korea, China importantly, as well as India and Indonesia. And I think when we look across the markets here, there's very clearly opportunities in contrast to the low, close to zero yields that we see in the developed markets. If you look at a market like India or Indonesia, you're getting around 7%, 6 to 7% yield, and we think that's very attractive from a global perspective. If we extend that analysis and we start to think about markets, from a credit point of view in Asia, if we look at the Jpmorgan Asian Credit Index, which measures credit in the US dollar market here in Asia, you're getting a yield also of just below 4%, so about 3.75% for an average investment grade market. And although we've seen a rally in spreads, they're currently just above 300 basis points, which is actually higher than the average over the last 10 years. We're actually seeing quite good value in those markets as well. So I think there's some interesting opportunities for investors when they look at Asia.
So what I'm hearing is that in the bigger picture, Asian bonds is in a sweet spot in the global context. It offers attractive and sustainable yields for global investors to take advantage of. I'd like to move on to the next topic, sustainable investing, or some people call it ESG investing. I personally believe this was somewhat overshadowed by COVID-19 this year, but it really turns out that 2020 was a phenomenal year for ESG investing. Looking at Morningstar data, the AUM of ESG funds has crossed the 1 trillion mark. So I'd like to hear what our audience is thinking on this topic. Let's go on to our second poll question. To our participants, do you take into consideration E, S, and G factors during your investment decision process? So there's a choice of three, A, B, and C. A for yes, B for no, and C for I want to but unsure how. So the data is coming in. We're seeing majority of them in between the yes and I want to and not sure how. So we're seeing roughly 46% leaning on the yes, 4% on the no, and 45% on the I want to but unsure how. So the data is still coming in. It's still shifting between split between the yes and I want to but unsure how. Okay, I think the data is kind of settled. So it's quite split. So just shy of 50% on the yes and just shy of the 50%. So 47 on I want to but unsure how. So Murray, what do you see or how would you describe as the current state of ESG investing, in the Asian bond context? And why should investors be paying attention to this?
Yeah, thanks, Jason. And I think they're very interesting poll results again. And I think it also points to some of the changes that we've seen in terms of the market and the perception of clients about ESG investing over the past decade. If we think back in terms of the development of the market, even over the last 5 years, we've seen the amount of engagement from clients and the corporates that we invest into, as well as regulators in the market, has really started to focus a lot more on ESG investing. Even a few years ago, when we were being asked by our clients about ESG and how we approached it from a portfolio viewpoint, the questions were very high level. 1 or 2 questions about do we do ESG? Do we embed it into our research? And really, over the last 2 years or even 18 months, the depth of the questions have increased a lot, and we're now starting to be asked about outcomes. Not only do we consider ESG, but what does it mean to us as an investment team, and how does it affect our investment portfolios? So, I think it's important to mention when we approach ESG that we've been embedding it into our research for well over a decade. Our credit research team covers over 500 credits. We have a very large team that's spread across the region. And when they approach ESG, they look at each of those individual risks and they provide a score on those risks for each individual corporate that we invest into. ultimately those risks and how they score those risks can feed into our internal credit ratings for investing and affect whether we actually buy a credit or not in the portfolio, which I think is really key when we start to think about outcomes from ESG investing. So I think the short answer is really yes. Investors should be thinking about ESG. We've had some really important announcements just over the last couple of months, with regards to an issue like climate change, where governments in China, Japan, as well as Korea have made commitments to becoming carbon neutral by 2050 and 2060. And when we look at this, we think that it's important for investors to consider how that might impact their portfolios, the risks that may come with that, issues such as stranded assets. But importantly, I think there are opportunities, and I think that investors should be looking for that as well.
I think that's a very interesting point. Like you just mentioned opportunities. So a question on top of our mind is the relationship between ESG investing and the potential source of alpha or potential return. So before we return to Murray to give us more insights on ESG opportunities, I'd like to hear what our audience is thinking. So let's load up our third poll question. Do you think ESG investing is a potential source of alpha? So you've got to our participants a choice of three: yes, no, or I don't know. So the results are coming in. We're seeing it leaning a bit more towards the yes, currently around just over 65% and roughly 35% on the I don't know. We're seeing 0 on the no. So let's just give it another 10 seconds to let this data settle. So we're seeing now 68% towards yes and roughly 30% to I don't know. So roughly 70-30. So Murray, what's your take on this, and what are the opportunities you and your team is seeing on the ground?
Thanks, Jason. And again, it's really interesting to see how our clients and investors' perception of ESG investing has been changing over the last few years. And it's pleasing to see that we have almost 70% of people looking at ESG as an opportunity or a source of alpha in portfolios. And that certainly aligns with our experience in terms of looking at ESG risks in our portfolios and how we think that the market will continue to develop going forward. And certainly when we look at things, issues across ESG, certainly it's always been easy historically to talk about the risks that come, particularly around issues such as governance. It's always been a really important factor to consider. Particularly in the high-yield universe in Asia. But we are, as I said before, I think we're starting to see more engagement on issues like environmental, things such as climate change. We're seeing more green bonds being issued. And we're also starting to see social issues coming to the fore. And 2021, as you mentioned, COVID might have disrupted the development of ESG investing, but it hasn't actually. We've seen a really large increase in the number of social bonds being issued into the market. So, I think that's a nice segue into bringing up our next chart. And so, what we've done here is we've brought up the Jpmorgan Asian Credit Index, which I mentioned before, which is a broad measure of the market here in Asia. And what we've done is compare it to a newly created Jpmorgan ESG Asia Credit Index. So what they did was they took away the existing index and they reweighted it on the basis of ESG factors from using data from third-party providers. They excluded some sectors such as thermal coal. But what you can see if you look at the left-hand side of this chart is that really over the last 8 years with the historical track record that Jpmorgan's produced, there's no difference at all from a historical perspective. And when we first started talking about ESG in Asia, going back over the last 10 years, a lot of clients asked us, and it was a relevant question, what did it cost us for considering ESG factors? And what we've found from a historical basis, looking at this study and studies done in other markets, is that there's very little to no difference in terms of the cost, but actually over recent times, and certainly over the last year, that we're starting to see more opportunities. And when we start to think about some of the regulations that can be coming through, some of the changes in the structures of the markets, the drivers of returns, investment returns in Asia over the past decade might not necessarily be the drivers in the coming decade. So, we think that there's some exciting opportunities to invest in the market. On the right-hand side is an interesting chart, and it shows you the carbon intensity of the Jackie index, as well as the carbon intensity of the newly created Jpmorgan ESG Asia Credit Index. It's no surprise, given that Asia accounts for almost 50% or over 50% of carbon released globally, that we have manufacturers in our index, and ultimately that means that the index has a relatively large carbon footprint. And so this is the intensity of the corporate issuers. It's tons of CO2 equivalent over $1 million worth of revenue, and you can see that the Jpmorgan Asian Credit Index actually has a relatively high carbon intensity. So by reweighting your portfolio and considering ESG and particularly environmental issues, you can see that the carbon intensity of your portfolio declines by 50%. So, a very strong and positive outcome by looking at it from this point of view. And if you combine that with, just glancing over to the left-hand side, you're actually not giving up anything from a historical basis for doing that, which is very interesting. Recently we launched a strategy, a thematic strategy based on sustainable investing, because we do believe that it's an opportunity, and we want to present our clients with the tools to be able to take advantage of that in the coming years. And on the right-hand side of that chart, you can see the carbon intensity of that particular strategy. So again, by giving a focus on ESG issues, and particularly a focus on themes such as climate change, you can achieve a strong reduction in terms of carbon density of the portfolio and still look to take advantage of the opportunities. When I think about some of the opportunities that have come up this year, one of the examples that we like to talk to clients about is the divergence in terms of the performance between a traditional high yield sector in Asia being Indonesian coal, and that of a relatively new sector in Asia being the Indian renewable utility sector. So for roughly the same rating, in terms of the same maturity, both in the high yield markets and roughly the same coupon, the Indian renewable energy space has actually really strongly performed relative to the Indian coal sector. And I think that is a really good example of some of the opportunities that can come from the market in the coming years. Another example is in China, we're actually starting to see quite a large number of Chinese property firms coming and issuing green bonds to the market. And we think that, again, that's a really nice development that will help to provide enhanced opportunities for portfolios in the coming years.
So after hearing, what you said, Murray, I personally and I strongly feel that ESG investing has experienced significant development globally, both on the sophistication of the demand side as well as the deepening of the investment landscape. But importantly, we're seeing emerging ESG opportunities within the Asian bond space. We should not only consider, ESG risk, but actively take advantage of these ESG opportunities. So moving on to China, China is a significant component of the Asian bond universe, both in the local and hard currency space. This year, FTSE Weekly announced will be including China onshore bonds into the index starting from 2021. So this is the last of the three major bond index after Bloomberg Barclays, after Jpmorgan. So Murray, what do you think is next for China bonds? What are the opportunities your team is seeing on the ground?
I think the FTSE inclusion is a continued development of what we've been seeing in China in recent years. And now with the three major bond indices, have China inclusion. But we really see this as merely just the start of the development, for China in the China bond market. The inclusion is the end result of more than a decade of developments to bring the onshore market up to the standard that we expect to see in the international markets. This has included improvements in secondary bond market liquidity, enhancements to foreign exchange market structure, as well as the development of global settlement and custody arrangements. These developments, have been really key. But I think it's important to remember that the client's exposure to the China bond market is still relatively low by global standards. We're talking, around 3%, which is much lower than what we would expect to see for a global or a developed market. And our view is that we would expect to see clients' exposure to China and the Chinese onshore bond market to rise towards 10% over time. But we have to remember that China's quite a large bond market. It's over 14 trillion US, and really to get to that type of 10% number is quite a significant amount of investment that needs to happen over the next 3 to 5 years. And so we think that that's really going to be a structural support from the bond market, but also the currency as we start to see clients or continue to see clients looking to take advantage of what's available onshore in China. And I think that's probably a good opportunity really to bring up the next chart onto the screen. So this is IMF data, and I don't think it should necessarily be a surprise to many of our viewers that China accounts for the largest amount of world trade flow in terms of this chart at just over 12%. And on the right-hand side is really what I was speaking to just before, which is the underrepresentation of China in terms of portfolio holdings globally. And what we've chosen here is actually the official foreign reserve currency composition from the second quarter of 2020. And so you can see, even from this viewpoint, that China represents only 2% of that particular data. And so there's really we feel a fantastic opportunity for clients to look towards China and to try to take advantage of that opportunity and the structural support that will come from reweighting of portfolios over time. If we look at the currency market in China year to date, the CNH and the CNY, they've rallied by just over 6%, and that makes China one of the best performing currency markets, in the region. And from the lows of March of this year, really over the second half of this year, we saw almost a 10% rally in the Chinese currency. So when we look forward to 2021, we're not really expecting to see the same type of aggressive rally of what we've seen so far in 2020, and particularly during the second half of this year. We expect the currency to continue to appreciate over the medium term, but I think the pace of that appreciation will moderate somewhat to next year. But it's important, I think, to consider that the structural elements of what has helped support that, not just the inflows, but also the handling of COVID. China and I think Asia in general has done fairly well if you think of it more broadly in terms of the handling of COVID. And China, in terms of the economy, has opened up. Certainly we saw the retail numbers yesterday relatively positive, and those types of structural supports will continue to next year. If we think back to the first slide with China, China's onshore bond yields and the sovereign yields at 3.2%, with inflation starting to roll over and fall a little bit, we're talking about a real yield of around 2%. And we think that provides, in conjunction with the currency, a really good opportunity for investors to be looking at in 2021.
So looking at China bonds, there's a strong case for foreign ownership to grow. It's a high-grade bond market, by international standards, and it offers compelling interest rate and currency opportunities ahead. I'm starting to see some of the questions coming in, so we'll try to go through them as much as we can. So let's start off with our first question. This is about the vaccine trials as well as the U.S. administration. So with more promising trial results on the vaccine ahead and the new U.S. administration, what should investors expect for Asian bonds in 2021?
Yeah, I think when we think about the vaccine and the global, I guess the global factors that can come and affect the markets here in Asia for 2021, they are obviously two really important factors that could feed into returns. I think firstly from a US government point of view, so far what we're seeing in terms of the announcement from Biden is that there will be a much more consensus-led government compared maybe to what we've seen under the last 4 years of Trump. Certainly, I think that means that we're going to have a more multilateral approach, a more consensus-led approach, and a less unilateral approach than what we have been seeing. I think communication is probably going to be a little bit less volatile than what we've seen over the last few years. And I think from a market point of view, we like to see less volatility. And I think we've already started to see the market price that potentially as a positive outcome for 2021. When it comes to the vaccine, and I think also for the administration in the US, they've made it very clear, the new administration, that fighting and recovering from COVID is going to be one of their main priorities. And we expect that that's going to be a really big focus for Biden in the first half of the year. In terms of the vaccine, we have seen some really positive news in the recent months. And we're starting to see the rollout of vaccination programs globally. Our view is that it's going to take some time for the vaccines to make it to the wider community. That type of logistic risk, I guess, and time that it takes for that to happen, it's probably still going to be, a drag on growth, COVID, throughout 2021, but particularly during the first half of the year. And what that ultimately means for our markets here in Asia is that really continues to underpin the low interest rate environment that we're going to see globally. And then that low interest rate environment, and again, going back to the first slide, Asia really stands out from both the local markets as well as a hard currency credit point of view. So, we think that the opportunities in Asia will remain for 2021. Not just because of COVID, but also because Asia and the fundamentals of Asia remain relatively strong when compared to many global markets.
All right. We've got some time left, and we're seeing more sustainable questions. So the first one is, how would what's your take when it comes to ESG investing on an active basis versus a passive?
I think that's an eternal question for our markets in general. But I think if we focus specifically on active versus passive for ESG investing, and particularly in Asia, I think there's a really strong case for active investing, and that's because the data in Asia is still incomplete. We do access all the major data providers as part of our investment process, and that's considered, but we really have to go out in some instances and in many instances and actually go out and engage with our issuers in the market and collect that data. So I think by taking a passive approach, you can actually end up with names in your portfolio that have a relatively high default risk. Another angle to that answer is really, when it comes to things like ESG bonds, so, we're talking about green, social, sustainable, and even blue bonds in Asia. We have seen some issuers come to market and issue bonds that we wouldn't necessarily buy because we reject them on an ESG basis for governance risks or other factors. And, I think if you're taking a passive approach, you may also end up with some exposures in your portfolios that don't necessarily align with your views on what should be in an ESG portfolio.
So this second question revolves around green bonds. So one of our participants are saying, there's potentially more potential on green bonds to move the needle when it comes to environment versus stocks. I know you're more of an expert on the fixed income, but maybe you can comment, what's your experience with green bonds compared to traditional bonds in general?
Yeah, the green bond market in Asia has grown quite dramatically in the last few years, and from just 5 or so years ago, there really wasn't a lot of green bonds being issued across the region, and we've seen green bonds emerge as an asset class, not just in the Asian credit space, but also in the local markets, and particularly in China, where we've seen quite a large number of green bonds being issued. If we focus on the Asian credit space, green bonds, have been coming quite a fair bit. And although we did have some disruption in 2020 initially because of COVID, the market really bounced back in the second half of the year in terms of the issuance. And what we found actually over time is that these bonds are tending to be bought by investors that have very strong hands. So I guess the dynamic in terms of investors and particularly during market sell-offs, we've seen that green bonds and ESG bonds in generally have performed relatively well because they don't seem to be under the same pressures to sell as the broader market. So, looking ahead to next year, we are expecting a pretty strong year for ESG bond issuance. We saw almost $40 billion worth of US dollar ESG bond debt being issued in 2021, and I expect that we'll see, in 2020, and I expect that we'll see an even bigger number in 2021.
Right. We're approaching the end of the session, and Murray, we've covered a lot of topics today. From your perspective, how you would tie this up all together as a key takeaway for our audience today?
I think it's really about the slides that we've put up throughout the session. Firstly, Asia has a yield differential, a positive yield differential between us and global markets. And it's not just in Asian local markets, it's also in hard currency US dollar debt. We think there's strong opportunities for investors in a low yield environment to get exposure to an investment grade markets with an attractive yield or an attractive spread. We think that the sustainable investing market will continue to develop in 2021. We think that we are starting to see a lot more engagements with clients. We are actually starting to see a lot more activity around sustainable investing and ESG investing, and we think that will continue in 2021. And then I think, thirdly, and equally important, is China. The China bond market is opening up. We are starting to see strong inflows into that market, and for good reasons, because of that yield that I mentioned before, both from a nominal viewpoint as well as a real yield viewpoint, and then finally because of the currency and the appreciation that we've been seeing.
Murray, thank you for your insights, to the Asian bond market as well as sustainable investing. To everyone who's joined us online today, we thank you for your participation. We hope to see you soon.